Salam guys, in light of the recent market drop and many stocks losing 30 to 50% of their market value from the highs, and if you have your cash reserve situation sorted out, then I think it may be a good idea for you to start hunting for bargains in the stock market if you think you're going to be able to stomach the immense volatility that we're likely going to experience in the near future. In order to assist you in your bargain hunting, I'm going to share with you 5 financial ratios that I like to look at in order to ascertain whether a particular investment is a good buy or not. So without further ado, let's get started. Assalamu alaikum, my name is Rakan Kayali and welcome to Practical Islamic Finance, where we try to understand financial matters and build wealth in a way that is in line with Islamic principles. If you like the content that I'm putting out and you enjoyed my videos, then I kindly ask that you leave a like because this really helps the YouTube algorithm know to promote my videos more. And don't forget to subscribe if you'd like to know when new videos are uploaded. By the way, if you're taking advantage of the less travel and less going out to get your finances in order, you may want to consider paying off your debt. And Fund Me BFF is a way for you to do so in a halal way. We provide halal funding that can be used for basically anything, including paying off any debt that you may have. Check out fundmebff.com for more details on how our halal funding works. Additionally, if you'd like to diversify your investments with an investment that has very little correlation with the stock market and pays out monthly to its investors, then go to fundmebff.com and apply to become an investor. By law, we can only accept investors that earn at least $200,000 annually. Alright, so let's start with my list of the 5 financial ratios I use to ascertain whether a stock is a good buy or not. The first financial ratio that I like to look at is the price to earnings ratio, commonly known as the PE ratio. To calculate the PE ratio, you just take the price of the stock currently and divide it by the earnings per share over the last 12 months. So the PE ratio is telling you how many dollars you're paying for every dollar in earnings that the company earned in the last 12 months. The higher the PE ratio, the more expensive a stock is. The lower the PE ratio, the less expensive or the cheaper the stock is. Now, one of the major drawbacks of the PE ratio is that it doesn't take into account at all any of the reinvestments that the company is doing with its earnings, and therefore it doesn't capture any of the growth prospects of the company. The natural progression of a company is that when it starts, its earnings is very low and it reinvests basically everything it earns back into the business because it's growing. And therefore, the PE ratio during this time may be negative if it has negative earnings per share, or it may be extremely high if it's earning very little compared to what it's being traded at. And this may give you the impression that this stock is overvalued, when in fact it's fairly valued because the growth prospects of the company are very high. Amazon is a good example of this. So for the longest time, Amazon would reinvest basically everything it earned back into the business. And its PE ratio was extremely high for a very long time. And only recently has Amazon started to consistently post positive earnings per share, and its PE ratio has come down a bit, although it's still pretty high because it reinvests a lot of its earnings back into the business. If you were looking at the PE ratio of Amazon 5 years ago or 10 years ago, you may have thought that, oh, this stock is way overvalued. When in fact, if you looked at the growth prospects of Amazon as a company at that time, you would have found that the stock was undervalued. So it's important to always remember that PE doesn't capture the growth prospects of a particular company. Now, there's something called forward PE, which basically takes the price of the share today and divides it by the expected earnings over the next 12 months. And that will give you a slightly better idea than the trailing PE, the normal PE that we talked about, where you were looking at the previous 12 months. However, a lot of times the reinvestments of earnings that a company will make will not bear fruit in the next 12 months. And they may need 2 or 3 or 5 years in order to bear fruit and show up in the growth of the company. So even a forward PE will not fully capture the true growth prospects of a company because it only looks at the next 12 months. So in summary, PE is a good multiple for comparing companies that are not considered growth companies. They're not expected to grow faster than the economy in general. However, PE is not that good a multiple for comparing growth companies with one another. For that, it's better to use the second multiple that I want to talk to you about, which is the PEG ratio. The PEG ratio is the PE divided by the annualized growth rate. So the price divided by the earnings divided by the annualized growth rate. And the annualized growth rate is basically whatever you decide to use. So you could use the trailing 5 years and annualize the growth rate over the trailing 5 years and use that for your G. Or you could use the next 3 years or the next 5 years. If you look at Yahoo Finance, for instance, they use the annualized growth rate expected over the next 5 years. So if a company has a PE of 30 and an annualized growth rate of 30%, its PEG ratio would be 1. 30 over 30 or 1. And just like with PE, the lower the PEG ratio, the cheaper the stock is. The higher the PEG ratio, the more expensive the stock is. Now, the drawback of the PEG ratio is that it doesn't give you information about the PE or the growth separately. So if you have a high PEG ratio, does that mean that the PE is high or that the growth is low? And conversely, if you have a low PEG ratio, does that mean that the PE is low or that the growth is high? So for instance, if I told you that the PEG ratio of GM was 0.5, you may say, wow, that means that GM is going to grow extremely rapidly or has been growing extremely rapidly. But in fact, the reason why its PEG ratio is that low is because its PE is really low. By the way, I am not recommending GM stock. I think you should stay away from that stock like you stay away from a rabid raccoon with a rusty syringe in its mouth. There's a lot of problems with that company. But what I am saying is that just as the PE ratio shouldn't be used for comparing growth companies with one another, the PEG ratio should really only be used for comparing growth companies. The next multiple that I like to look at is the return on equity. And to calculate the return on equity, you just take the net income that's attributable to shareholders and you divide it by shareholder equity. This ratio tells you how much net income a company is able to generate from every $1 in common equity. So a return on equity of 1 tells us that for every $1 a common stockholder owns in the company is able to generate $1 in net income. The return on equity is often a good metric for assessing the efficiency of the management team for a particular company because it tells you for every $1 that you give it, how much net income is it able to generate. Now, there are some caveats to using return on equity. So, for example, Apple's return on equity for the last 3 months in 2019 was around 60%. On the other hand, Amazon's return on equity for that same period, the last 3 months of 2019, was around 20%. So does this mean that the efficiency of Apple's management team is 3 times as much as the efficiency of Amazon's management team? Not quite. As we mentioned about Amazon, Amazon is famously known for reinvesting a lot of its earnings back into the business. Additionally, you know how I said return on equity tells you how much money a company is able to generate for every $1 in common equity? Well, that doesn't tell us anything about how much debt the company uses to generate this net income. So in the case of Apple, they have around $110 to $120 billion in debt, which it's also using to generate its net income. Amazon, on the other hand, has around $77 billion in debt. So Apple has a lot more debt. Now, in order to make a fair comparison between these two debt amounts, you have to look at the next multiple that I'd like to talk to you about, which is the debt to equity ratio. The debt to equity ratio is basically the total liabilities a company has divided by that company's shareholder equity. The debt to equity ratio is a good way to gauge how much a company relies on debt in its operations. Higher debt to equity ratios are typically associated with higher risk for investors. This is because debt creates fixed liabilities that the company has to service regardless of its cash flows. So if business is down and cash flows are tight, then companies with a large amount of debt on their books may have problems coming up with their debt payments. So this is an especially important metric to look at when you're shopping for bargains nowadays, during this time where the economy has stopped and it's not really clear as of yet when the economy is going to pick up again. So you want to only invest in companies that you're sure are going to make it to the other side and are not going to default on their debt payments. Keep in mind, a healthy debt-to-equity ratio will largely depend on the industry that the company is in. Now, as it relates to halal and haram, there are some commentators who have suggested or proposed that there be some fixed limit for the debt-to-equity ratio for the investment to be halal, and basically below that limit, the investment is halal, above it, the investment is haram. And as I've pointed out in previous videos, this really doesn't have much merit because, first of all, there is nothing in the Quran or Hadith that supports such an arbitrary limit. Second, the fact that the debt-to-equity ratio is really reliant on what the market is valuing the company at the time, and basically for the same amount of debt, if the market is really optimistic about the prospects of the company, the debt-to-equity ratio will be lower. And if they are pessimistic about the prospects of the company, the debt-to-equity ratio would be higher because the denominator would be lower. This basically means that Muslim investors can only invest in companies that are expensive, and they can't invest in companies that are less expensive or cheaper. And that really doesn't make much sense to me. And then third, you have to remember that debt in Islam is not forbidden. It's interest on debt that is forbidden. And just knowing the dollar amount of the debt that a company has doesn't tell us anything about the interest rate that is on that debt. So recently, a lot of companies have been loading up on a lot of debt because it was basically free money for them. And this may inflate the debt-to-equity ratio for these companies. And they may be paying very little interest on that debt versus some other company that has a much lower debt-to-equity ratio, but it's paying really high interest rates on whatever debt it has. So for those reasons, I don't think it makes much sense to put an arbitrary limit on the debt-to-equity ratio in order to call a company halal to invest in or haram to invest in. At least that's my opinion, that's my thinking on the topic, and of course Allah knows best. The drawback of the debt-to-equity ratio is that it doesn't tell us anything about when this debt becomes due. So for instance, if you have two companies and one of them has $10 million in debt that is coming due in the next year and $1 million in long-term debt, and a second company that has $1 million in debt that is coming due in the next year and $10 million in long-term debt, and let's assume that both companies have the same amount of equity, the same amount of shareholder equity, both of these companies would have the same debt-to-equity ratio because they would have the same amount of total debt. Both companies have 11 million in total debt. However, the company that has $10 million that is coming due in the next year is going to be a lot more risky, all else being equal, than the other company that only has $1 million coming due in the next year. So if you're trying to assess the ability of a company to meet its short-term liabilities, you should look at the current ratio in addition to the debt-to-equity ratio. And the current ratio equals the current assets divided by the current liabilities. Current assets are assets that are either cash or can become cash within a year. So they're liquid assets. Current liabilities, on the other hand, are liabilities that will come due in the next year. Accordingly, the current ratio measures the company's ability to meet its short-term financial obligations. So if you're looking at an airline stock to buy because their prices have dropped dramatically in the recent crisis, then make sure that you're looking at the airline's current ratio so that you know that the company is going to be able to be solvent and not go bankrupt if this crisis extends for a prolonged period of time. The ideal current ratio, just as with all the ratios that I shared with you, depends on the industry that the company is in. Now, after all this, I think it's important for me to mention that financial ratios and multiples are only part of a stock's story. It's important to understand these ratios in the context of the particular story of the company and the overall environment in which the company finds itself in. And only after that understanding and understanding the business of the stock that you're evaluating should you make any investment decisions. I hope you found this video beneficial. If you did, I kindly ask that you leave a like, subscribe for more content. If you need halal funding and you live in the United States, go to fundmebff.com. If you're an investor and you're looking for an investment that has little correlation with the stock market and that pays out monthly dividends, then go to fundmebff.com and apply to become an investor. By law, we can only accept investors that earn at least $200,000 annually. Until next time, take care of yourself. Assalamu alaikum and peace be upon you all.